everybody, Serge Berger here from the Steady Wealth Podcast. Welcome to another episode. Today we're going to talk about something that I think a lot of self-directed investors are typically not focusing on. And that has to do with more the avoidance of mistakes rather than trying to find the next holy grail and improving win rates of their investments and trades and maximizing profits and minimizing losses, although the latter might go into this. And it basically has a lot to do with what I empirically can tell you, not only for myself, but also from clients that we advise at Blue Marlin, and certainly clients that we have on the research side at the Study Trader, which is Blue Oak Advisors, that I can empirically see people do. I strongly believe that avoiding silly mistakes, and by silly, we could possibly even use the word stupid sometimes, and that's not to be condescending towards someone's intellect here. These are things that happen, but we want to minimize mistakes. So I'm going to give you in this episode a whole bunch of things. I'm going to call them easy wins that can keep us from portfolio blowups. But before we look at that and go through sort of a checklist on this, let me just preface this by saying that if I look at the average investor that we look at and talk to about him and becoming better, I see a lot of them having probably roughly between 40 and 60% winning positions. If one is way above that, they tend to be a little bit above average. If they're below that, they tend to be beginners and almost doing something on purpose. But somewhere between 40% and 60, 70% of winning trades or investments, which is a lot, by the way. The higher end of that, of course, the lower end is one can still have a profitable strategy. But what I typically tend to see is those people, which encompasses the majority of people, by the way, would be able to become a lot more profitable if they only avoided making a few, I'm gonna use the word stupid mistakes here. Let me just walk you through a few of those things. And so if you think about this, it's a very liberating feeling, and I'm speaking from personal experience, to focus more on, I'm going to call this risk management, because it falls under the idea of risk management, to avoid stupid things as opposed to constantly trying to become better and squeezing out more profits and all that kind of stuff, which is that puts a lot of pressure on us, which in turn has downward spiraling effects. So let's think about some of the easy things we can do. I made a few notes here, so I'm going to write this. So one of the easy things to do is, or stop doing, is basically pretending to be a full-time investor and trader, a self-directed, but really not being that. And most of these, or actually all of these, are going to be real examples, either from myself or from a client. Let's say one considers to be a full-time investor. This is a client X, starts to retire. Real example of a client decides to go on a cruise, but he considers himself to be a self-directed investor. Goes on a 1.5 week cruise with his wife. During that time, he was planning to be on the computer a little bit, but not paying more attention than maybe 10 minutes a day, which is already a big mistake if one considers them to be a self-directed. And then, of course, the internet went out on the boat. Right? It can happen. They had a defect, no internet for half the time or something like that. He had a whole bunch of positions open, and basically one of them blew up. Like literally blew up the portfolio, down 30%. So an easy mistake is to, when we go on vacation, let's square our books. Sounds like an oversimplistic thing to do, but a lot of people don't do that. Another thing to do is not overtrade. Now, this one is easier said than done because it's tough to quantify that. What's overtrading? What I see most people doing that are self-directed is they think there's something to do every single day. A lot of times there's not something to do every single day unless it's an adjustment. There may be something to do several times a week, but maybe not every single day. The opposite is undertrading. That can happen as well. If someone considers themselves to be self-directed and they're just, allocating in through every part of the economic cycle, not making any changes, there's always a change to be made, not every day, but certainly several times a year even from a passive perspective in a portfolio, adding a bit more here, lowering something here, just as even a sector rotation or moving more to bonds or more to equities, whatever, that kind of thing. So under trading could be an easy win too, by getting rid of that. Just missing major economic movements. If we hear that inflation's exploding and it's in the headline everywhere, reducing the bond portfolio a little bit or reducing interest rate sensitive things is an easy thing to do. That does not require a PhD in economics or being a professional hedge fund, which is also, by the way, why I strongly advise everyone to have an investment advisor, whether it's us at Blue Marlin Advisors, bluemarlinadvisor.com, or it's anyone else. I just think everyone needs an investment advisor because there's a lot of data out there in news flow that one needs to be aware of. And again, these are simple things that we can do. Over leveraging is a big one. Over leveraging is anyone can cut that out tomorrow. Over leveraging tends to happen more in the derivatives market, although I've seen people do it with straight equities and ETFs as well. But it's more common, at least from what I've seen, in options and particularly in futures, where people don't understand how much a futures contract can move because they're not aware of the tick size or they're not aware of contract details, which is a whole nother ball of wax. I'll talk about that in a minute. But over leveraging, let's assume one wants to buy a futures contract, equities, whatever the thing is, whatever it encompasses, maybe it's bonds, not being aware of how much leverage that has. An easy fix, right? You go to the website of the official contract, maybe it's the CME website, I don't know, whatever the futures contract might be, and looking at the details, which gets us to the second point about futures and leveraging. Not understanding the details of the contract. That's another big one. Like not understanding when that contract expires and then getting financial or physical delivery of something. That's not fun. In the options market, right? Not being aware when an option is set to expire. That's an easy fix. Avoiding a big drawdown, not being aware of that. Another big one, and a lot of you folks that are followers with us at the Steady Trader list, holding a trading position, let's say, particularly if it's in a stock, through that stock's earnings report. Unless, of course, you purposely want to do that, and I would strongly disencourage anyone from holding trading positions through earnings because that's a gamble. That's an easy thing to fix. A lot of people blow up trades just by not being aware when an earnings report is. Silly mistake. And also being aware when a correlated stock has an earnings report. So for example, let's say one has a call option in Home Depot or call spread, just simple thing. They're not aware of, forget Home Depot itself. What about Lowe's, which is highly correlated to Home Depot in terms of the news sensitivity? Now, these two companies happen to report earnings, I think, typically 1 or 2 days within each other. So this may not be the best example. But even then, it's important to be aware of when a very close competitor, not being aware of a major lawsuit or ignoring something like that in a company that's like making headline news, right? There's every company has, or lots of huge companies have little lawsuits here and there, but typically they become more systemic problems by the time they've made the headline. So that's another thing. Honestly, chasing charts. I know this is a bit more technical. If one is in the habit of getting bullish when a stock had just made a 20-30% move, when getting bearish when a stock dropped 20-30%, that's typically not a great way to make money. That's an easy way to in my view, to fix blowups. Another one, and again, this is one that I think a lot of people have ignored for now 12, 13 years, lack of diversification. How can we get easy wins of not blowing up our portfolio? Diversify, right? So that means diversification within, let's say, an equity portfolio, but also diversifying away from equities. What about some bonds? Someone right now is probably saying, well, Serge, stocks and bonds had horrible years for 2 years in a row. That's correct. Typically, though, a long period of time, that doesn't add up. The point is diversify, right? Whether you want to diversify between stocks and bonds is a side topic, but diversification, diversifying in commodities, in ETF. The great thing about ETFs, by the way, right now, and we use a lot of ETFs, is one can diversify a portfolio into all sorts of things, even international stuff, which is another big thing I would encourage anyone to look at. Obviously, one that everyone will say was not adhering to a stop loss. That's important, yes. However, I would argue the things I just mentioned become more important than the stop loss. Emotional decision making, buying something because a neighbor told us to buy some without doing any research. That's an easy win, I think, for most people to be able to overcome. I would even throw in making investment and trading decisions while we're on vacation or while the markets is slow. So what a lot of people tend to do, this is a really easy win. Okay, I would encourage everyone to take this to heart, take it from personal experience. What I tend to see a lot of part-timers or who believe they're full-time investment traders but they're really not. They're still working or they're retired and they'd rather do something else. They become very active when they have time, which implies that they think the market's just going to wait for them to be ready to start looking at the market, which of course is lunacy. The classic example is someone who goes on vacation in the summer, and that's when they become very active traders because now they're on vacation, they have time. But is that really good time to be trading and investing? Maybe, maybe not. The point is to be selective in when we do something and not do something when we have time to do it. Another great example is Christmas, New Year. A lot of people that are employed have time off then. So what do? They become more, or they look at the markets more and make decisions when really the odds of making money and making good investment decisions in late December are very low. Another easy win, right? Easy wins here is what this is all about. Easy ways to avoid stupid blows, stupid mistakes. And if we can avoid all those things that I just mentioned, imagine what that would do to a portfolio. Think about it for yourself. And you can answer the question. I can't answer the question for you, but maybe think about it for yourself. If you say to yourself, okay, I could have avoided that. Yes, I held that stock through that option position through an earnings report or that stock position. Yes, I left my trades run while I was on vacation and couldn't do anything. Yes, I was hectically trading during Christmas, New Year. Just imagine that, or not being aware of a major economic shift. Writing a stock down from 200 to 50. There's no reason to do that, right? Use something very simple. Use simple 200-day moving averages. I'm not a big fan of using oversimplistic analysis, but what if I told you, what if someone bought, and I'm just looking at another screen here, what if one was bought, and I always bring this example up because it's just, I think everyone can resonate with or relate to. What if someone bought, let's say Peloton, okay? Peloton is they make exercise bikes. During the pandemic, someone bought Peloton somewhere at $50 if they were lucky. That's low, probably more closer to $100. Let's say someone bought it at 50 for argument's sake. The stock rallied all the way up to 170. Currently, as I'm recording this, it's at 4 or 5, 4.5. Okay. Just not using something simple like a 200-day moving average to get rid of something, right? That's an easy win. So just think about, what if you would have done any of these things? Could that potentially have avoided a lot of losses? And could that, and this is really the point here, this is what this podcast episode is all about, could that have been a more profitable decision, stopping us out at a 200-day moving average and not writing a stock down from 170 to 5, even if one bought it at 50? Could that have made or saved you potentially more money than finding the next chart chase breakout that lasts a couple days and then reverts, right? Again, I'm posing questions here. I don't have the answer for you because everyone's got a different portfolio, a different situation, so on and so forth. So this podcast is all about the easy wins that can help us, and arguably my experience from what we're seeing with our clients and my experience from me personally too would probably make our portfolios much more profitable than trying to find the latest chart chase. So before we do anything in terms of trying to become a better chart breakouter or whatever we want to do, and I tend to not be in favor of that very hectic short-term trading kind of stuff, how can we avoid some stupid mistakes, right? That's what this is all about. And I would argue, as we head here towards the end of 2023, we just have a few trading weeks left on the calendar. At the very latest, I would encourage everyone to think about this here for the rest of the year, and then maybe start applying some of these things as we head into 2024. At the end of the day, investing and trading, a lot of it is between our ears. But we also have to understand that it takes a lot of time if we really want to do it ourselves. For the record, and I keep saying this, I would encourage anyone who wants to be self-directed to, yes, do that, be self-directed. but have an investment advisor, to someone to talk things through with, right? Managing one's entire net worth, I think, is for most people way too much to do. Have an investment advisor, someone you can talk to. A newsletter is not enough. A newsletter is great. Chat rooms are great. That's great for information, but you still have to talk to that. I would encourage anyone to do that. And that, for the most part, is also why we see that investors that have investment advisors to work with, to partner with, just to talk through stuff, they tend to do a lot better than a self-directed person themselves who just has a bunch of newsletters. That's factually proven, by the way. Not saying every single person that applies to, but for the most part, on average, that applies to people. So I'm hoping I'm giving you some easy win ideas here. Let us know how it helps. You can always email us, support@thesteadytrader.com, or hit us up anywhere. Even if you're watching this on YouTube, maybe you can leave a comment down below or in one of the podcast episodes on one of the podcast platforms. Thanks so much for listening, folks. Have a wonderful rest of your day and week, and we'll see you again in the next Study Wealth podcast episode.